This is Nightly Business Report with Tyler Matheson and Susie Guerin.
Correction, please. Some market watchers say stocks have risen too far for too long without a 10% pullback. We'll ask two top pros what they think.
Where's the spike? Why oil and gas prices aren't rising sharply, along with tensions in Iraq.
A graying nation, 10,000 baby boomers turn 65 every day. And that could have a major, lasting impact on our economy. Tonight, we begin a four-part series, Aging in America. All that and the return of Susie Guerin on Nightly Business Report for Monday, August 11th.
Good evening, everyone. Yes, I'm back. Topping our news tonight, another positive day on Wall Street as investors were able to look past the Russia-Ukraine conflict and the escalating tensions in Iraq. Good news, right? Well, not for many investors. They're puzzled about how and why stocks can keep going up, avoiding the correction that so many have predicted after a 5-year bull run. And with political turmoil and economic uncertainty all around the world, the rise in equities has confounded the experts. Here's how the major averages ended today's session. The Dow rose 16 points, the Nasdaq up 30, and the S&P added 5 points.
Unnatural. That's how Mark Lucchini, chief investment strategist at Janney Montgomery Scott, describes a stock market that hasn't experienced a 10% pullback in 3 years. So, would investors be on firmer footing if there'd been a wicked sell-off or two? And do stocks need to correct before they can move reliably higher? Mark Lucchini joins us now, as does Jack Ablin, Chief Investment Officer with BMO Private Bank. Gentlemen, good to have you here. Mark, let me just start with you. Do we need a pullback for the market really to be healthy?
I don't think we need a pullback, Tyler, at least not in that vein. Certainly, like many, I would welcome one because I do think it would re-energize equity investors at more attractive valuations than exist at the moment. But there's no immutable law that says we have to have a correction defined as a decline of 10% or more. In fact, over the last 34 years, while 19 of those 34 years there has been a correction of that order of magnitude, it hasn't obviously been 100%. And so as a consequence, I think as long as we continue to see the economic and corporate fundamentals improving, that should allow for stock prices to advance commensurate with earnings growth. And so I don't think we need to have one in order to invite continued interest in equities.
Jack, you are of a different opinion. You think we do need a correction in the stock market. Tell us why.
Sure. I think that there are a lot of investors sitting on the sidelines because valuations are expensive. Now, I think Mark is right. As long as earnings can outpace current valuations for a while and revenues can outpace them, perhaps we could move forward without a correction. But I think the fact is that with valuations expensive and the economy doing okay, we could use a pullback to get some of this cash that's sitting on the sidelines into the market.
So that's the good side, Jack, of a market pullback. In other words, when valuations go down, it attracts more money in?
Yeah. So, I mean, I can, in our own case, I mean, if someone were to open an account with us today and give us 100% cash, I would have a difficult time buying certainly small caps. I wouldn't touch small caps at these levels, and they've already had nearly a 10% correction. But large caps, I would have to really be careful and pick and choose, where we would go. I certainly would not just make a lump sum allocation to equities at this level.
Mark, a lot of people are keeping score of how many days it's been since we've had a market correction. It's something like 1,000 plus. If you look back in Wall Street history, there have been periods that have gone even longer than this without a correction. So, I mean, just answer the question. Is it bad or is it good not to have a correction?
Well, I think it's good not to have a correction as long as equity prices continue to be supported by the fundamentals. I think, on the other hand, Susie, it would be bad if we saw a melt-up in equity prices in the absence of cooperating fundamentals, which drove valuations to egregiously high levels. And while I mostly agree with what Jack said, I will differ, is I don't think valuations are all that expensive. I think valuations in the U.S. equity market at about 15 times, a little more than that, perhaps, forward 12-month earnings are full, I wouldn't argue that they're expensive. And as a consequence, particularly given the lack of alternatives in bonds and cash for risk-based capital, I think equities can go higher without the need for a corrective phase.
So, Jack, it seems like there are a couple of things that may have sort of changed the equation a little bit. One is that the period of high liquidity, of easy money, does seem to be changing. The Fed certainly is cutting back on the bond purchases and likely will raise interest rates next year. There is heightened geopolitical concern around the world. How likely do you think a 10% pullback is in the market over, let's say, the period between now and the end of the year? And what would you do? Where would you put money if one happens?
Sure, it's entirely likely. I think that, that I agree with Mark. Through the lens of bonds, stocks do look cheap, but that is the only lens in which stocks look cheap because profit margins are near all-time record. Relative to sales, just the revenues, stocks are probably 25 percentage points above their median levels. So if we do get a continued pullback in liquidity, which I believe has been the driver of the market over the last 12 to 18 months or so, it's entirely likely we'd go to cash and sit it out. We watch liquidity in credit spreads, and we watch momentum in just the market action itself. And that could prompt us to reduce our risk and go to cash.
A spirited discussion, gentlemen. Thank you very much. Mark Lucchini with Janney Montgomery and Jack Ablin with BMO Private Bank.
Well, for all the talk about a market correction, there are some S&P 500 stocks that have fallen sharply from their 52-week highs, and some have even plunged into correction status. But could some of those hard-hit companies now be poised for a comeback? Dominic Chu has the story.
It was shaping up to be the pullback in stocks that so many traders had been waiting for. Geopolitical risks were flaring up all around the globe, and stocks began selling off. But that drop was short-lived. For now, the large-cap S&P 500 index dipped just 4% over the last couple of weeks, and bargain hunters stepped in.
Coming out of this pullback, we think areas that are reflective of economic growth should be probably the best areas to be in, and that would be mostly energy, industrials, and technology.
Many investors who are looking for bigger returns in the stock market often look towards the stocks that have been beaten up in trading, the ones that have fallen the most since their recent highs. Out of the 500 stocks in the large-cap S&P, more than a third of them have fallen by at least 10% from their respective peaks over the last year. Out of those, just 30 stocks have lost a fifth of their value or more, a level that many traders call bear market territory. Among the hardest hit stocks are internet retail giant Amazon.com, also luxury goods retailer Coach, and upscale grocer Whole Foods. Investors in all three have sold shares because of concerns over things like future growth and stiffer competition. But the sell-off in shares has given some traders a reason to give these companies another look. Some experts are looking even deeper into those companies with particular strengths.
Nordstrom and Macy's and people like that who have had very strong online capabilities, that's where the retail leadership has been and probably will continue if there is any leadership out of retail.
Retail stocks will be especially important this week as companies like Macy's and Walmart help to wind down large-cap earnings season. Those reports may help shed more light on the health of the consumer and whether or not beaten-up stocks can bounce back. For Nightly Business Report, I'm Dominic Chu.
In remarks widely interpreted as indicating he favors accommodative Fed policies aimed at supporting economic growth, new Federal Reserve Vice Chair Stanley Fischer called post-recession U.S. and global economic performance disappointing. Speaking at a conference in Stockholm, he questioned whether the sluggish growth was merely cyclical or, as some economists maintain, structural. Whichever it turns out to be, Fischer said the result has been a general downshift in forecasts for long-term U.S. growth.
Over in the oil patch today, a big corporate restructuring announced by the nation's biggest energy pipeline company. Kinder Morgan is consolidating its huge oil and gas pipeline business into a single company. It's a $44 billion transaction, and investors liked what they heard. Shares of Kinder Morgan gushed higher by 9%. Morgan Brennan has more on what's behind this massive change.
Kinder Morgan announcing plans to combine its 4 businesses to become the largest energy infrastructure company in America. Valued at $71 billion, it will be the second biggest energy deal in U.S. history. behind Exxon's $74.5 billion purchase of Mobil in 1999. The consolidation will put Kinder Morgan Energy Partners, Kinder Morgan Management, and El Paso Pipeline under the Kinder Morgan Inc. umbrella, bringing together storage containers, terminal operations, and 80,000 miles of oil and gas pipelines. But to do this, the company is abandoning the master limited partnership structure associated with some of its businesses, putting assets into a single C corporation.
First and foremost, I think the simplification of 4 entities going into 1. Also, you had this, a C Corp and 3 basically MLPs. Now you're going to have 1 entity, and I think it's going to be a great way to play the energy renaissance going forward.
MLPs have become very popular in the energy sector because of their tax advantages and high dividends. But Kinder Morgan founder Richard Kinder, widely considered a pioneer in the MLP space, says his partnerships have gotten too big to make significant investments and maintain growth. He says the C Corporation will actually lower the cost of capital and result in tax savings.
You put all that together, and we think this is a recipe for us being able to do lots of capital projects and lots of potential acquisitions that we simply couldn't do under the old structure.
The move also enables the combined company to increase its dividend to $2 next year and then continue raising it 10% annually through 2020. As for potential acquisitions, analysts note that the company will now be able to acquire all kinds of energy assets, not just infrastructure, which is what the MLPs were limited to. Even so, Kinder Morgan says it plans to continue investing in infrastructure, that there could be 120 energy MLPs that it could potentially target. And with $640 billion in new tanks and storage expected by 2035, that there will be plenty of room to now grow. For Nightly Business Report, I'm Morgan Brennan.
Another oil giant, Shell, appears to be pulling back on shale. According to the Wall Street Journal, private equity firm Blackstone Group is close to a $1.2 billion deal to buy a 50% stake in natural gas assets in the Haynesville Shale Formation underneath Louisiana and Texas. That is now owned by Royal Dutch Shell. Neither company will confirm the report.
Well, while shale exits the shale business, several other energy giants are scaling back operations in the wake of increasing violence in Iraq. And just this evening, President Obama said he stands ready to support the new government in that country and that the U.S. has stepped up military advice to the Iraqis and Kurds.
The past few days, American forces have successfully conducted targeted airstrikes to prevent terrorist forces from advancing on the city of Erbil and to protect American civilians there. Kurdish forces on the ground continue to defend their city, and we've stepped up military advice and assistance to Iraqi and Kurdish forces as they wage the fight against ISIL.
But what do these moves of the energy giants mean for the major oil companies and for oil prices? Jackie DeAngelis reports.
As the situation in northern Iraq remains tense, reports that U.S. oil majors like Chevron, Exxon, and Hess are removing non-essential employees from the region are a concern for the markets. Normally, news like this would cause oil prices to spike, but this time, the markets seem to be acting rationally. That's because of Iraq's 3 million barrels a day of production, only 360,000 come from the north, and only a third of those are exported. Iraq's Ministry of Natural Resources saying this weekend that production in the north hasn't been interrupted.
The south is what we're really worried about. 3 million barrels a day come from there, and if there's any disruption to the world, to that supply, it's going to be problems for the rest of the world.
In the Middle East and Iraq specifically, expat workers are no strangers to conflict. Evacuations like this have been seen before, many times just temporary and part of standard operating safety procedures. What draws expats to the region? High salaries. Oil and gas industry workers are paid for the risk that they assume. RigZone says that average salaries are over $90,000, and in some cases where employees have more experience, they can bump into the six-figure range. Also keeping crude prices in check, a balance in supply and demand. Barring any major catastrophes, global supply is on the rise, and demand seasonally in places like China and the United States is weakening.
While geopolitical tensions have eased in certain parts of the world, they still remain a problem with Russia and Iraq in particular. But really in the fourth quarter, demand usually drops, and that could offset any geopolitical tensions.
The good news? Domestic prices for crude have backed off almost 3% in a month, now back below $100 a barrel, and gas prices have declined as well. The Lundberg survey reporting another 6-cent drop in the last 2 weeks, bringing the national average for a gallon of regular to $3.52. So where does crude go from here? Traders say unless geopolitics really explode, crude prices are headed lower. For Nightly Business Report, I'm Jackie DeAngelis.
Coming up on the program, Amazon's new playbook, picking a fight over pricing, this time with Disney. But which company will blink first? That's next.
The U.S. Postal Service delivering some bad news. Overall revenue rose 2% in the third quarter thanks to a boost in shipping and package services. But the post office lost $2 billion during the past 3 months on another big drop in first-class mail. Postal Service has now recorded a loss in 21 of the past 23 quarters.
Once again, Amazon.com is embroiled in a heated contract dispute with a major content provider. And this time, it's blocking pre-orders of some of this year's biggest movies from Disney. So what's Amazon after, and could this fight be good news for consumers? Julia Borston has the story.
If you go to Amazon to pre-order DVDs or Blu-ray discs of two of the biggest films of the year, Captain America: The Winter Soldier and Maleficent, both from Disney, you're out of luck. Amazon allows users to pre-order digital downloads, but does not give the option of pre-ordering the DVDs. Neither Amazon nor Disney will comment, but the two companies are clearly in a dispute over pricing.
Amazon is trying to use whatever leverage it has to squeeze some kind of a concession out of Disney. I don't know if that's on pricing or some other type of terms, but most likely pricing. And I think that what's interesting about it is that Amazon, not being a brick and mortar retailer, doesn't really care about pre-orders.
This is just one of many standoffs Amazon has had with content giants. Earlier this year, cutting off pre-orders of Warner Brothers DVDs, including 300 Rise of an Empire. Though Amazon and Warner Brothers came to an agreement, Amazon is still in the midst of a pricing battle with book publisher Hachette over ebook prices. Hachette objected to Amazon's push to lower ebook prices, Amazon responding by suspending advance orders of some Hachette titles, reducing discounts and slowing delivery. The battle escalating with writers taking out an ad to protest Amazon's actions.
This battle with Amazon is really all about the lifeblood of the publishing industry. So if they negotiate a discount on books, then the publishers actually eat it and the authors eat it. I mean, this is their only chance at monetizing that creative content is selling books. So when Amazon squeezes them on price, everybody in the creative side and the publishing side loses.
While Pachter predicts Disney and Amazon will come to an agreement fairly soon, he warns that the book battle with stakes so high could continue to drag on. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Shares of the nation's largest milk processor slump, and that is where we begin tonight's market focus. Dean Foods reported a wider than expected second quarter loss and warned on its third quarter. The reason? Raw milk prices remain, quote, unpredictable and volatile. The company also pulled its full year forecast, calling this the most difficult operating environment in its history. That sent shares curdling 3% lower to $15.20. Better than expected earnings for Priceline. The online travel company reported a jump in international bookings for hotels, airlines, rental cars. But the company also spent a lot to expand globally, and that will pressure its third quarter results. Nevertheless, shares of Priceline up 2% to $1,309.28. And shareholders of Mattress Firm will sleep well tonight. Shares of the mattress retailer bounced after the company said it expects earnings and sales to exceed market expectations. The company also raised its outlook for the year, 13% gain today to $54.53.
It was the opposite story for GoGo. This in-flight communications and entertainment provider reported a second quarter loss and says operating profit this year will be at the low end of its prior guidance. The company blamed the weak forecast on higher costs to expand its business. Shares fell nearly 5% to $15.24. Sanofi and Mankind are teaming up. The French drug maker agreeing to pay Mankind $925 million for the global rights to the world's only available inhaled insulin. The deal comes just about 2 months after the drug won regulatory approval in the U.S. Shares of Mankind rose 4.5% to $8.53. Sanofi, though, fell slightly to $52.09. And Intercept Pharmaceuticals soaring after hours after more details were released about clinical trials for its experimental liver drug, OCA. The company says the drug showed improvement in 46% of patients with serious fatty liver disease versus 21% with a placebo. Shares were up 1% in the regular session, but then you can see the spike after hours once that data was released.
Coming up, a large portion of Americans' population is getting older, and that could mean big changes for our economy. Tonight, we begin a 4-part series on aging in America.
With thousands of American workers putting in their retirement papers every single day, we're kicking off a 4-part series called Aging in America. We begin part 1 tonight with a look at the impact of what an aging population, along with an older workforce, would have on the U.S. economy. Steve Leisman has our story.
Every day in America, 10,000 baby boomers turn 65. By 2030, their population is set to grow from today's 45 million to 72 million, or a fifth of the population. For economists, these used to be much scarier numbers. They raised fears that an aging population would lower growth permanently, that an older workforce would be much less productive. But that view has changed. While the boom in baby boomers presents serious challenges, the new thinking is far more optimistic.
The really good news in our economy is that the employment patterns for the 55-plus group have been going steadily up for the last generation.
They've also learned that when you make a few changes in the workplace, the productivity of older and younger workers is about the same. Like brighter lights on the factory floor or bigger computer screens in the office. Finally, technology can be a major part of the solution, replacing the work of retirees who leave the workforce. Still, the problems presented by baby boomers are considerable and won't solve themselves.
The analogy is saying, oh my God, those picnickers down by the seashore at low tide are all going to drown. Well, yes, of course they'll drown if they don't move, but they can move.
Moving could mean finding new ways to curtail the rise of healthcare costs. Government spending for healthcare and Social Security will double from an average of 7% of GDP over the last 40 years to 14% by 2039. And it may also include raising some taxes on the young or the wealthy to pay for the baby boomers' retirement. Immigration reform and better overall economic growth can be a big part of the solution.
Economically, it is much easier to address these kind of issues if you act sooner rather than later, because you've got both more time so that you could, for example, implement whatever tax increases or benefit reductions you might make over a longer horizon.
Unfortunately for some baby boomers, the one agreed solution could be the worst. They're going to have to work longer and save more. But there's some justification. One study found the self-reported health of 69-year-olds today is about the same as 60-year-olds back in the 1970s. Stats like that help put the problems into perspective.
The fact that that we've added 40 years to the human lifespan is way overweighs any economic disadvantage we have, because that's the biggest treasure. Don't get depressed about the aging population. It's the best thing that's ever happened in the history of the world.
For Nightly Business Report, Steve Leisman.
History of the world. Well, tomorrow we're going to continue our series, Aging in America, with a look at the impact on the healthcare industry, something I have a lot to say about, having
just gone through. Welcome back. I wish everybody could see this wonderful pink cast and the beautiful matching pedicure down. It's a wonderful, nice to have you back.
Nice to be back. And don't say break a leg.
No, I won't.
Not to me.
No.
That's Nightly Business Report for tonight. And we want to remind you that this is the time of year your public television station seeks your support.
And I'm Tyler Matheson. On behalf of your public TV station, thank you for your support, and we'll hope to see you back here tomorrow night.
I'm Susie Garrett with the Nightly Business Report News Brief. Investors were able to look past the Russia-Ukraine conflict and escalating tensions in Iraq, sending stocks higher again today, despite continued predictions about a correction in the markets. The Dow rose 16 points, the Nasdaq up 30, and the S&P added 5 points. Shares of energy giant Kinder Morgan gushed 9% higher after announcing a $44 billion deal to consolidate all its oil and gas pipeline businesses under one roof. The U.S. Postal Service lost $2 billion last quarter. Package deliveries were up, but first-class mail fell again. And Amazon is embroiled in another heated contract battle with a content provider, this time with Disney, putting off pre-orders for popular movies. Be sure to tune into Nightly Business Report right here on your public television station.